Imagine you are sitting at your kitchen table on a Tuesday morning, watching the news, and the word strike appears on the screen. Not a labor strike, an airstrike, Iran. And within the next 4 hours, oil is up 12%, the futures market is flashing red, and your mortgage rate, which you were supposed to lock in that afternoon, has just moved against you by a quarter point. You did not do anything wrong. You made no bad decision. The system just lurched, and now the number that governed your financial life this morning is no longer the number that governs it tonight. That is the moment this story is actually about. Not the geopolitics, not the missiles. The moment when a central bank that was supposed to be focused on inflation and employment suddenly finds itself staring at a map of the Middle East, us trying to decide what to do with interest rates when the world just changed shape. The Federal Reserve was not designed to respond to war. Its mandate is domestic, price stability, maximum employment. Two things you can theoretically measure, model, and adjust for, but history keeps delivering a third variable that no mandate covers: sudden, violent geopolitical shock. And when that shock involves Iran, involves oil, involves the Strait of Hormuz, the Fed does not get to sit it out. It gets pulled in whether it wants to be or not. Here is what makes this complicated. When a military confrontation with Iran begins, or even credibly threatens to begin, oil prices move first. They move fast. They move before any economic data can confirm anything. And oil is not just a commodity. It is a cost that runs through nearly every price in the economy. Shipping costs more. Manufacturing costs more. Grocery distribution costs more. The family filling up their minivan on a Wednesday morning is already living inside the Fed's problem before the Fed has even held an emergency call. So the question the FOMC faces is not abstract. It is this: do you raise rates to fight the inflation that the oil shock is about to create, or do you hold, or even cut, because the same shock is about to strangle growth? And the brutal answer is that both things happen at once. That is not a theoretical edge case. That is exactly what happened in the 1970s, and the Fed got it wrong in ways that took a decade to repair. Go back to 1973. The Arab oil embargo hits. Oil prices quadruple in months. The Fed, under Arthur Burns, it faces the same fork in the road. Inflation is surging, but the economy is also slowing. Burns does not want to be blamed for a recession, so he keeps policy looser than the inflation picture warrants. What follows is stagflation, the word economists invented to describe the thing they said could not happen. Prices rising and growth dying at the same time. The working family in Ohio watching their heating bill double while their factory cuts hours. The Fed's hesitation did not protect them, it extended the pain. But here is where the story gets more complicated. Because the 1970s lesson, the lesson that says you must fight inflation hard no matter what, almost became its own trap. Fast forward to 2022. The Fed, having watched inflation run hot for months while calling it transitory, finally pivots to aggressive rate hikes. And for a moment, the logic holds. But then imagine layering a major Iran escalation on top of that tightening cycle. Oil spikes again. The Fed is already hiking. Does it accelerate? Does it pause? Because now you have two inflationary forces compounding. One from energy, one from a labor market that is still tight, and rate hikes that are already slowing housing, slowing credit, slowing the parts of the economy that were not the problem. That is the trap. The oil shock creates inflation the Fed cannot cure with rates alone. You cannot drill more oil by raising the federal funds rate. You cannot reopen a blocked strait by tightening credit. What you can do is crush domestic demand enough that people stop buying things, including things they need, until the price pressure eases. That is a real policy option. It is also a policy that lands hardest on the people with the least cushion. The pensioner on a fixed income who is already watching grocery prices outrun her monthly check. The small restaurant owner who buys diesel for his delivery van and propane for his kitchen and cannot pass every cost increase onto customers who are already pulling back. These are the people inside the FOMC's spreadsheet, even if they never appear by name. Now, here is the reversal that most people miss. When Iran becomes a live military flashpoint, the instinct is to assume the Fed will tighten, because war means oil, oil means inflation, inflation means higher rates. But the documented pattern is more surprising. In several historical cases of acute geopolitical shock, the Fed's first move was not to tighten, it was to flood the system with liquidity, to stabilize financial markets before worrying about prices. After September 11th, the Fed cut rates and injected liquidity within days. The immediate fear was not inflation. It was that the financial system itself would seize, that credit markets would freeze, that banks would stop trusting each other, that the payment infrastructure of the economy would crack under the psychological weight of the event. And so, the Fed chose the function of the system over the price level. It chose to keep money moving before worrying about how much that money was worth. That decision looks different depending on where you sit. If you are a bondholder watching the real value of your fixed payments quietly erode, the Fed just chose someone else's stability over yours. If you are a business owner who needed a credit line to make payroll that week, the Fed just kept your doors open. Same policy, completely different experience. This is the deeper pattern that emerges when you study what the FOMC actually does under geopolitical pressure, not what its mandate says it should do. It is managing multiple crises simultaneously: the price crisis, the credit crisis, the confidence crisis, and they do not all point in the same direction. Iran escalation specifically creates a version of this where the oil shock is real and lasting, but the financial panic can be short-lived if contained quickly. The question is which crisis the Fed decides is the primary one. And that decision reveals something about what the institution actually values when forced to choose. There is a moment in 1979 that crystallizes this perfectly. Paul Volcker takes over the Fed in August. By November, he has implemented a dramatic policy shift, targeting money supply rather than interest rates, that effectively allows rates to rise to whatever level is needed to break inflation. The prime rate eventually hits 21%. 21. Mortgages become nearly unreachable. Small businesses close. The recession that follows is brutal. But Volcker had made a different calculation than Burns had made 6 years earlier. He decided that the credibility of the institution, the Fed's ability to be believed when it said it would fight inflation, was worth more than the short-term pain of a recession. He was right, but the people who paid the price of that credibility restoration were not the people who had caused the inflation. That asymmetry never fully disappears. It is still there when the FOMC sits down today and looks at a map where Iranian proxies have struck a shipping corridor, where oil futures have jumped, where the bond market is already repricing, and where the next inflation print is 3 weeks away. The committee does not have a clean answer. It has a set of painful trade-offs wrapped inside a political moment, wrapped inside an economic model that was not built for this. What the historical record actually shows, across 1973, 1979, 1990, when Iraq invaded Kuwait and oil spiked again, across the post-2001 period, across every moment where geopolitical shock met monetary policy, is that the Fed's response is never purely technical. It is always a judgment about which problem is more dangerous right now. Inflation that compounds quietly over years, eroding savings and wages and trust, or a financial seizure that happens fast, shuts down credit, and creates a different kind of damage in a matter of weeks. And the thing that changes when Iran specifically is the variable is the oil dimension. Because Iran is not just a geopolitical actor, It sits on one of the most critical choke points for global oil supply. A serious escalation does not just spike prices for a week. It introduces a structural uncertainty into energy markets that can persist for months. Shipping insurance goes up. Rerouting costs go up. The entire pricing architecture of the global economy shifts slightly, and that shift does not reverse the moment a ceasefire is announced. The market remembers. The price embeds the risk premium, and the Fed is left fighting an inflation that is partly psychological, partly structural, and only partly addressable through the tools it actually has. So what does the FOMC do? The honest answer, drawn from the full weight of this history, is that it buys time. It signals. It adjusts its language before it adjusts its rates. It tries to manage expectations as a first-order tool because expectations about future prices are themselves inflationary. If everyone believes oil will stay high and inflation will persist, they will price that belief into wages and contracts and rents, and then it will persist, regardless of what the actual oil supply does. The Fed knows this. Managing the story is part of managing the economy. That Tuesday morning at your kitchen table, oil up 12%, your mortgage rate moved against you, the news still scrolling. You were already inside that story. The Fed was not yet speaking, but the market had already priced in what it thought the Fed would have to do. And that expectation, that collective guess about future policy, was already reshaping the cost of borrowing money in your life. Not because of anything the FOMC decided, because of what everyone assumed it would eventually decide. The strike happened, the price moved, and somewhere in the space between those two facts, the institution that was built to manage your economy was doing what it has always done in these moments, trying to hold two contradictory truths at once, knowing it cannot satisfy both, knowing that whoever it disappoints will remember, and knowing that the history of getting this wrong is long enough to fill a room. That is not a failure of the system. That is what the system actually is when the world stops cooperating with its models.